Hello everyone and welcome to Public Citizen's webinar on gas prices. My name is Allison Fisher. I'm the Outreach Director for Public Citizen's Energy Program, and I'm going to be moderating today's call. Also with us is the program's Director, Tyson Slocum. He's going to be presenting on today's issue. He's going to walk us through our action plan for addressing oil market speculation and also fielding your questions on this issue toward the end of the hour. But before I turn it over to Tyson, I do have a few housekeeping items and announcements. So first I'd like to draw your attention to the control panel. You should see it on the right-hand side of your screen. And down toward the bottom, there is a chat tab. So for your purposes, during the call, you can use the chat function to communicate with us if there's any technical issues. You can also use it to start a dialogue with other participants. And then you're also going to use this function to submit any questions that you might have for the Q&A portion of the call. So we do plan to reserve about 20 minutes for Q&A. And as I mentioned, you can submit a question through the chat tab, but you can go ahead and do that at any time during the presentation. And we're going to do our best to make sure that we get to all the questions, time permitting. I also want to let you know that we are attempting to cover a lot of ground today, but don't worry if things are moving too quickly, because each of you will receive a recording of the webinar and a follow-up email that will probably go out early next week. We are also planning on posting the webinar on our website at www.citizen.org. So any of those two ways, you can have access to this webinar after today. I also want to take a moment to acknowledge the wonderful response that we received from our activists after we sent out the invitation for this webinar. Registration hit capacity within just several hours. And we also received several emails from activists that are concerned about and have some ideas about gas prices. On this note, I just want to thank everybody for taking the time to contact us and let you know that we do our best to make sure that we respond to your questions and comments. And I'd also like to invite you to send us suggestions for future webinars. So if there's anything that we work on that you hear from us about through your action alerts or visiting our website or blog, and you want to learn more about it, please send us an email at energy@citizen.org. And please use the subject line webinar. That way it'll be easier for us to call through all of those suggestions. So lastly, I do want to say just a few words before we get started about the scope of today's webinar. The area of gas prices, the cost of oil, our dependency on fossil fuels is vast. And we could probably do a 5-part series and maybe still not cover all of the ground that we'd like to. But for the purposes of today and for the hour that we have together, we're going to just spend a good chunk of time talking about the effect of financial speculation on gas prices and what together we can do about it. So that said, we do hope that we can further broaden the discussion during the Q&A period. And again, just want to thank everybody for joining us. And at this time, I'm going to go ahead and turn it over to our presenter, Tyson Slocum.
Allison, thank you so much, and thank you to all of the public citizen supporters and activists that are joining us today. We cannot do our work without the actions that you take, the many of you that choose to make modest financial contributions to our organization. We rely on the actions and support of folks just like you, and so we're very appreciative of that, and so I just want to thank you. So I've been working on energy prices and gas price issues for since the Enron scandal in California back in 2000. And what we're going to talk about is just a little bit about what's behind the current high prices and some of the issues that Public Citizen is actively engaged in to try and address the issue. Many Americans don't realize that the United States is actually a massive fossil fuel producer, and in fact, we're the third largest oil producer on the planet. Only the Saudis and the Russians produce more oil every day than we do. The United States produces more than 9 million barrels of oil a day. The problem is that we use 18 million barrels of oil a day. Also, many Americans don't realize that the largest source of imports to provide that 49% of oil that we have to import to meet our daily needs, almost half of that comes from North America. Canada and Mexico. Canada is the largest importer of oil to the United States. And as you can see on our presentation, the Persian Gulf, we receive less than a fifth of our imports from that volatile region. So the United States is a huge oil producer, and while our daily production is large, we do not have enormous reserves in the ground. And that's why our ability to vastly increase the rate of production is very limited. And that's why the capacity of us to try and lower prices by engaging in additional domestic drilling isn't going to happen. And any politician that says that we can drill our way to low prices is lying. We cannot do that. And that's very important to know. And in fact, since about 2006, as oil prices began their steady increase, Americans have responded by driving less. And as a result, oil demand is actually flatlining. Over the last year, Americans have taken 500,000 barrels of oil off the road, off the market each day over the last year. That shows that Americans have been responding to these prices. It still has been very painful, and for a lot of Americans, they're doing all they can to limit their exposure to high prices, but they may not live in a community that provides adequate mass transit, or they don't have a family budget to buy a new, more fuel-efficient vehicle, and so forth. And one thing that the industry has responded is, in the face of this very weak domestic demand for gasoline, the oil industry is responding by exporting the petroleum products that are refined here. In fact, for the first time in 62 years, the United States is now a net exporter of petroleum products. We are exporting 3 million barrels of refined product like gasoline and diesel and jet fuel every day. So we've got this bizarre situation where we're importing half of our oil needs, around 9 or so million barrels of oil, but we're turning around and exporting 3 million of that in the form of refined products. And that's helping to keep gas prices a little higher than they otherwise would be. It also exposes the fallacy that proponents of, say, the Keystone pipeline that would bring Canadian tar sands oil into the United States, that's really just about importing Canadian oil to get it to the Gulf Coast refineries to prepare it for export, mainly to Mexico and Latin America, but eventually those exports are going to grow to Europe and to Asia. So we have to understand that there's been changing dynamics. Americans are using considerably less amounts of oil. Prices continue to go up, and the industry is responding by exporting record amounts of fuel. And here's a chart that we put together that really underscores this. In 1956, Congress passed the Interstate Highway Act, which radically transformed our transportation infrastructure to be reliant on gasoline-powered automobiles. And as you can see, at the time of the passage of that bill in 1956, the United States produced 100% of our oil needs because we're a big oil producer and we were able to produce enough. And as you saw, as you can see, in the years after that 1956 act, when the United States started to build trillions of dollars worth of road infrastructure, our capacity to supply our own oil needs evaporated. And it's important to note that we at Public Citizen do not believe that we're going to get back into that balance, and that the only way to address this is to aggressively move to alternatives to oil. And the oil companies are profiting not just from exporting the refined products, but from producing oil as well. The average cost to produce a barrel of oil for a company like ExxonMobil is about $20 a barrel. The market price is currently about $100 a barrel. So if you're an oil company like ExxonMobil, you're producing 2.5 million barrels of oil a day. That costs you about $20 to extract. You're selling it for 100. You can do the math and understand why these companies are so enormously profitable. But there's another element here, and this is something that we have focused on at Public Citizen, and that's the role that speculation plays in influencing the prices that we pay for oil and for gasoline at the pump. I most recently testified before the United States Senate on this topic in November of 2011. And what I told the Senate at that point is that speculation by financial players, by some oil companies, is adding about $25 to the price of a barrel of oil, which translates to about 60 cents a gallon. And I refer to this as a speculation tax. And you know, obviously there are global supply-demand issues. China and other emerging economies like India continue to use oil. You've got situations where the easy-to-get-at oil is quickly going away, and we are now faced with obtaining oil from more environmentally and more expensive, more environmentally challenging and more expensive sources like the Canadian tar sands, like ultra-deep-water drilling like we do in the Gulf of Mexico, oil shale like we see in North Dakota. This is all much more expensive. There are huge impacts on climate and on the environment for these unconventional oil sources. So, you know, oil shouldn't be at $30 a barrel. But as you know, I'm not Newt Gingrich. I'm not saying that I promise if Public Citizens reforms are enacted into law that we'd see gasoline at $2.50 a gallon. No, our estimates are that this speculation, this excessive speculation, represents about a quarter of the total price of oil, which is about 60 cents per gallon. So the speculators are primarily large financial institutions, the same types of financial institutions that were responsible for the financial crisis in 2008. And what we've seen is a huge transformation of these markets away from the oil companies and airlines that used to operate in these futures markets to buy and sell oil contracts to satisfy oil delivery commitments. In the 1990s, 80 to 85% of the market participants and the trading volume was dominated by the oil companies, by the airlines, by large industrial manufacturers, and about 15 to 20% were the speculators that were providing liquidity into the market and being a counterparty to these trades. That's a balance that worked very well. But a deregulation law in the year 2000 transformed the way that these markets operated. And you also have to remember that, you know, OPEC and Saudi Arabia, they don't set oil prices. They seek to influence these energy trading markets by increasing or decreasing their daily production of oil. But they don't unilaterally set prices. Prices for oil are set in these futures exchanges. And the futures exchanges in the United States are very significant globally because the United States uses so much oil. 1 out of every 4 barrels of oil in the world is consumed here in the United States every day. And so as a result, the trading markets in the U.S. Impact the prices globally because so much of the activity is focused here because we're such a large consumer and because we're such a large producer. And what we saw in 2000 was the transparency and accountability rules that govern these markets were deregulated. And this was legislation that was pushed by Enron. And what Enron and other energy trading companies wanted to do was to break free of all the different government regulations and have more freedom in the ability to trade oil and other energy commodities free from government oversight. Without having to report information to the government, it turned into a huge casino. And what we saw was massive volume moving away from the smaller exchanges that are fully regulated by the federal government into these unregulated formats. The growth of some of these unregulated exchanges increased more than 1,000% after the deregulation law of 2000. And what that has done is it's allowed speculators to drive market activity rather than the supply-demand fundamentals that are determined by how much American Airlines or Federal Express wants to buy for a barrel of oil and how much an oil company is willing to supply it. With the speculators in the market, the speculative volume has increased, and that is increasing the price. And the oil companies, or I should say the financial speculators, are making a fortune just as the oil companies are. And so the speculation really happens in the price of crude oil. And so what this chart is showing is the breakdown of a price of a gallon of gasoline. 65% of the price of a gallon of gasoline is the price of crude oil. About 25% is the costs associated with transporting it and refining it and delivering it to gas stations. And only 10% is retail taxes. The federal gas tax is 18.4 cents a gallon, where it's been since the early 1990s. And the average state tax is 22 to 25 cents a gallon. And so this just illustrates that taxes aren't driving up prices. It's the price of crude oil. And the price of crude oil is set by energy traders who overwhelmingly are being driven by speculative interests. And it's that part of crude oil that we're seeing the much higher prices at the pump. So the Dodd-Frank Financial Reform Act was passed Congress, and it's a piece of legislation that Public Citizen played a leading role in fighting for to hold Wall Street accountable. And the law actually sets out some great provisions that would undo that awful Enron-sponsored deregulation law by restoring transparency in these markets. It gave new authorities to the CFTC to require that all trades occur in an exchange or a venue that would be fully regulated by the federal government. So the federal government would, for the first time since 2000, be able to see all these trades and being able to monitor them to make sure there's no shenanigans. It would also set limits on the ability of an individual speculator like Goldman Sachs to control a significant chunk of the market. And it also would have set up financial disincentives to encourage speculation by making it much more expensive to speculate, by requiring speculators to put up more collateral or more margin, more money in order to make a bet. So the law is very strong. The problem is that a law is only as good as its execution. And there's an independent agency called the Commodity Futures Trading Commission that is tasked with regulating commodity markets, everything from wheat to orange juice to energy like natural gas and oil. And the CFTC is a 5-member commission that is made up of a mix of Democrats and Republicans. And what we saw was, after Wall Street lost on all these big issues in Dodd-Frank, they decided to intensify their lobbying efforts before the CFTC. And what we've seen is a very weak implementation of the Dodd-Frank statute. The CFTC did not implement a strong position limit standard, meaning the standards that would limit the ability of a speculator like Goldman Sachs to control a big chunk of the market. Those standards that they have put together are very weak. Their margin requirement rules are also very weak. And they have created massive loopholes that you could float an oil supertanker through that will not require a big chunk of active traders to have to trade in a regulated format. And so this is a huge problem. And in addition to these weak rules, the CFTC isn't yet done dealing with all of the definitions that are involved in the rules, and they won't be done and they won't take effect for about another year. So while we have this Dodd-Frank Act that on paper should be putting an end to the excessive speculation, what we're seeing in reality is Wall Street has succeeded in delaying or weakening the rules so that we actually have not had any changes over the way that these energy markets function. And that's part of the big problem right now. So back in April of 2011, the President, in response to concern by working families and businesses over the impact of high gasoline prices, announced that he was forming a task force on oil speculation that was going to be headed by the Attorney General, and it was going to have the CFTC along with the Federal Trade Commission and some other agencies. And it turns out that this task force really hasn't done anything. They've only met a handful of times. They haven't produced any report. They haven't done anything. And so it's been very disappointing. It was more of a press release than an actual initiative to crack down on what we believe to be excessive speculation in these markets by large financial institutions. So what is Public Citizens' Action Plan? Well, we agree with the President that we need stronger penalties for people that do violate the law. If you've got seriously tough financial and criminal penalties, it can act as a deterrent against some of these entities. So we agree with that. The problem has been that, as I said, the CFTC has these strong, has a capability to put together strong rules to crack down on speculation, but they actually haven't done it. And so what we have worked with folks in the Senate and the House, primarily the office of Senator Bernie Sanders, an independent from Vermont. He put together legislation called Senate Bill 1200 that does a couple of important things. It basically says, look, you at the CFTC, you didn't stand up to Wall Street influence and you put together weak rules. So now we're going to put in concrete statute what the rules need to be so you have no more wiggle room over there at the CFTC. And so what it would do is limit the ability of an individual speculator to have no more than 5% of the market. We have conducted research where at times one trader, like Goldman Sachs, has controlled 50% or more of all of the outstanding contracts in the oil markets. That's clearly uncompetitive. So we agree with Bernie Sanders on limiting it at 5% and also significantly raising margin requirements to about 12% of the amount of the bet placed. This imposes a financial penalty on speculators, and it also helps ensure a type of insurance, because if a speculator makes a bunch of bets and then goes bankrupt, that margin or collateral is insurance for the system that the counterparty doesn't fail as well. So it not only is a disincentive for speculation, but it also protects against systemic risk, which is very important. Another issue that we're advocating for is, of course, fully funding the CFTC. This year, the CFTC's budget is $205 million. Obama has requested $308 million for next year, and so we think at a minimum the budget should be increased to $308 million. Congress, though, continues to propose reducing the CFTC's budget to even under $200 million. And as we all know, you can have the strongest laws on the books, but if your enforcement agency doesn't have the staff or money to police these markets, it's going to be toothless. And of course, in addition to dealing with speculation, we're concerned, a public citizen, about the impact that high prices have on working families, and to the extent that those high prices are being caused by Wall Street and financial institution greed, we want to take concrete steps to restore some balance and limit the damage to working families. But as I said at the beginning, at the end of the day, the only way we're going to avoid exposure to the devastation that high energy prices have, to the climatic impacts of CO2 emissions from our oil addiction, from the local environmental issues associated with oil refining and tailpipe pollution, we have to aggressively move away from oil and into sustainability in our transportation sector. And Public Citizen played a leading role in 2009 and 2010 in working to develop carbon pricing legislation that was consumer friendly. And in fact, Public Citizen succeeded in working to endorse the only bipartisan climate bill in the United States Congress in 2010, in the Cantwell-Collins Act, which was sponsored by the Democratic Senator Maria Cantwell from Washington and the Republican Senator Susan Collins from Maine. And what this bill would do would basically set a carbon price, and the government would be in charge of collecting the revenues and the government would immediately then refund about 80% of the revenues it collected back to families in the form of a monthly dividend check or as a payroll tax deduction to help shield working families from the impact of higher prices that the carbon price would have. And then we'd have about $15 billion left over to spend every year on clean energy deployment. That's investment in mass transit. That's investment in making the electrification of the transportation sector more affordable. That's about the solar rooftop revolution and turning more of our buildings into clean energy generating stations. Because right now, the high prices that we're paying at the pump are going to Wall Street and they're going to oil companies. And they're not investing in sustainable transportation. They're not investing in the electrification of the transportation sector. They're not investing in solar power. If we've got higher prices due to a carbon tax and we're sending money back to families to help shield working folks from the impacts of these high prices, but at the same time delivering billions and billions of dollars in direct investment into mass transit, into livable communities, into the electrification of the transportation sector, and into solar power, that's the kind of transformative issue that is going to change us for the better and get us to be competitive globally. Some of the next steps, like Allison said, this webinar is going to be recorded and saved, and we'd love for you to share it with your friends, with your coworkers, with your relatives, with whoever, on Twitter, on Facebook, however you want to communicate with folks. And also we're going to have a petition there urging you to contact the Department of Justice to crack down on these speculators. Like I said, Obama made this big splashy announcement last year, and they haven't done anything. And that's because the American people haven't put any pressure on them to do so. And so addressing the excessive speculation is an easy ask and a good thing to target the administration on. And we also thought that it would be interesting for us to hear feedback on how high gas prices have been affecting you. We've already received some emails about people making purchases of Nissan Leafs and other electric vehicles and making other changes in their consumption patterns, and that's fantastic. That's the kind of leadership that always gets us really fired up at Public Citizen, when individuals are taking actions to address their own consumption behavior. But we also have to recognize the reality that millions and millions of families cannot afford to buy an electric vehicle. They can't even afford to buy a more fuel-efficient vehicle because they've only bought used cars in their life, and the used car market is dominated by gas guzzlers. There's a lot of people that would love to be able to take mass transit to work or to take their kids to daycare or whatever, but at the same time that gas prices are going up for working families, they're also going up for the county governments, for the municipal governments that are operating these mass transit bus systems. And what we're seeing at a time of high gas prices, when people need access to alternatives, county governments, local governments are cutting back on routes. They're cutting back on service, and they're increasing fares because the federal government isn't coming through with enough money and states aren't coming through with enough money. And so this is the quandary. How do we arm families with the tools they need to avoid high prices? Cracking down on speculators, you know, like I said, that's going to get prices down 60 cents. That's a good start. But we've got to have fundamental reforms, and we can do that by transforming the way our energy infrastructure operates. And we're going to do that. We're going to need to do that with money. And I think the best way to finance that is through some sort of carbon price that understands the regressive nature of carbon pricing. So we need to hold moderate and lower income families whole, but we need to have the billions of dollars we're going to need on an annual basis to invest in the clean energy revolution that we all need. So that concludes my remarks, and I will turn it over to Allison now. We can start to get to the great questions. Allison, are you there?
Oh, I'm sorry. I had muted myself. Can you hear me now?
Oh, that's okay.
Fantastic.
Yes,
yeah,
loud and clear.
I was typing away answering some questions on my own and was distracting people, so unfortunately I muted myself, but we're back. Great. So before we jump into the questions, of which we received a lot of great questions, and we're going to get to them in just a moment, I did want to, Tyson, if you could just go back to the slide before the last one.
Sure. This one?
Yeah, so as you were talking, I did get a couple of questions, people asking about where can they find this petition. So just to let you guys know, the purpose of the next steps is to give you guys a sense of what to expect from us over the course of the next month. So first of all, you know, we're going to be getting this recording out to you along with the slides, and we hope that you don't have to necessarily review them, but if you want to share them with your friends and family and engage them in discussion about this issue, that would be wonderful and help us out a lot. And then also in the next couple of weeks, we will be pushing out this petition. So the answer to the question is it does not exist on our website yet. It is something that we're in the process of putting together, and it's something that you will have in your inbox within the next couple of weeks here. So thank you for that question. I'm glad to see some enthusiasm about signing it. And then lastly, as Tyson mentioned, we have had a couple of emails that have where people have personally talked about how they have responded to the gas prices. This is going to be the subject of another email that will probably come out at the end of this month or early next month, where we're just going to ask this broad question to you all and hope that if you'd like, you can share this information with us. It's a way to just see how people are responding to gas prices, but also allow us to get to know our membership a little bit better. And of course, what we would do with that information is going to be a partnership between us and you. If you'd like to have it posted, if you'd like to post it in our Facebook or our blog, certainly that's an option, but we're not going to share that information with anybody else if you do not give us permission. So I just wanted to be clear on that. Great, so we have just 20 minutes for Q&A, so that's great. And I'm going to go up to our first question. This is coming in from Bob Jans. And his question, Tyson, to you is, if we've released oil from the reserves just to lower the cost, would the speculators be financially hurt by this? Is the first part of the question. And if so, do you think that that would teach them a lesson, a broader lesson, not to drive up the cost artificially? So this is the question about the strategic oil reserves.
Yeah, that's a great question. So in the 1970s, after the oil embargoes of that era, Congress created a national strategic petroleum reserve that currently has well over 700 million barrels of oil in it. And the intent was to fill that up during times of good supply and keep it in there and draw down in cases of supply disruptions. So there have been some times like Hurricane Katrina, disruptions of supply from major oil producers, where we've drawn that down. I'm actually agnostic on the issue of whether or not we should rely on releasing supplies from the Strategic Petroleum Reserve in an effort to bring prices down. I talked about earlier that we actually have significant overcapacity of refined products, and the Strategic Petroleum Reserve is not gasoline, it's not diesel, it's crude oil. So we've got huge surpluses of gasoline and diesel that we have produced. In fact, we've got so much excess gasoline, diesel, and other refined products that we're exporting 3 million barrels of that stuff a day, like I said, mainly to Latin America. So first, I think that releasing the Strategic Petroleum Reserve is not going to have a big impact on lowering prices. Like I said, this is not necessarily, the high prices we're seeing right now are not necessarily because of supply and demand, it's because of excessive speculation. So I think that the opportunities to utilize the Strategic Petroleum Reserve in an effort to reduce prices is going to be limited. It's not going to hurt, but it's also not going to help, I don't think. I hope that answers your question.
Great, thanks. So Tyson, often when gas prices go up, there are a series of short-term policy fixes that often emerge. One is what you just talked about. Should we or should we not release oil from the strategic reserve? Are there other types of provisions or policy fixes that happen to come up when prices are high?
Well, yeah, I mean, one of the things that we've already seen Congress enact are stronger fuel economy standards. In 2007, actually in the Bush administration, we set into motion a law that for the first time since the 1980s featured an increase in fuel economy standards. Those rules were then implemented by the Obama administration. And what we've got is, you know, in the next generation, fuel economy standards are going to have to be 50 miles to the gallon. That's a huge increase. And so that is one of the few right things that folks have done, that Congress has done in response to high prices, is increasing fuel economy standards. Another issue is fully funding mass transit. Right now we've got huge battles in Congress over how we're going to fund transportation initiatives. The Highway Trust Fund is financed by that 18.4 cent a gallon federal gas tax, and we continue to spend a vast majority of that Highway Trust Fund on building more highways and fixing more roads. And we have to do that. But we should be spending a heck of a lot more money on mass transit, on rail systems, because we have to understand that continuing to build roads isn't going to get us to sustainability. We have to rely on mass transit. Now, the United States, you know, doesn't have the population density that a lot of European and Japanese cities have. Many of our communities were developed during the age of the automobile. I talked about the huge transformation in the suburbs and in rural America with the Interstate Highway Act that literally reconfigured the development of cities around the automobile. And that's going to take another generation to undo, but we have to start spending today. So I think in response to your question, fuel economy standards promoting mass transit investments, and then, of course, promoting those incentives that are going to help working families afford to buy more fuel-efficient vehicles and more alternative fuel vehicles. I think that's going to be very important.
Those seem to be good solutions. Are there other false solutions that are floating around now?
Oh yeah, I mean the drill baby drill mantra that's being advocated by politicians, by a $100 million ad campaign by the American Petroleum Institute, which is the lobbying arm of big oil. Yeah, they say, look, the United States just needs to open up more areas to drill, and we can drill our way to lower prices. That is nothing short of a giant lie. We cannot produce our way to lower prices, just as releasing supplies from the Strategic Petroleum Reserve isn't going to result in lower prices, because it isn't a supply problem. Plus, the United States lacks the ample reserves that could make a difference. If we were Saudi Arabia, maybe. So drill baby drill will not deliver lower prices, and it also ignores the huge environmental and social costs associated with drilling for oil. How soon politicians forget April 2010 when BP, because it was under-regulated and prioritizing on earning short-term profits rather than protecting workers or the environment, engaged in the largest environmental and industrial disaster in American history that dumped millions of barrels of crude oil directly into the Gulf of Mexico, which we still don't even know the ecosystem damage to that. These same people are saying, well, we need to just understand that BP was a fluke and we need to drill for more oil in the deep water Gulf of Mexico. We need to bring more tar sands oil from Canada. We need to do more oil shale fracking for oil. All of this is environmentally disastrous. And so we have to understand that drill baby drill isn't just a lie from the price standpoint. It's also deeply irresponsible from a sustainability standpoint.
Great, thank you. So we have a great question coming in from Jen Norgard, and this is going to shift the conversation a little bit. This is another, I think, area that we could spend a whole hour on. Jen's is interested in the refineries and the role that they play in gas prices and determining our supply of oil imports and exports.
Right, that's an excellent question. Like I had laid out earlier, you know, the primary input in the price of a gallon of gasoline is crude oil, because we make gasoline from crude oil. So that's the biggest thing. But the refining sector plays a significant role. Like we say, about 25% of the price of a gallon of gas. And the refining industry in the United States is huge because we're the largest consumer of oil on the planet. So we built this huge refining industry to process 15, 20 million barrels of oil every day, right? Well, Americans are now using a lot less. We're responding to high prices by using considerably less, and so the refiners have responded in two ways. One, we have refinery closures on the East Coast because as supply exceeds demand, that has a downward effect on prices. So the industry responds by closing some refineries so they can make more money at their existing refineries, and, like I said earlier, engaging in record levels of gasoline and diesel exports. We're now exporting 3 million barrels of petroleum products every day. And that has an effect of increasing prices. Because if they weren't doing that exporting, we'd have a hugely oversupplied domestic market, and that would have a downward effect on prices. So the refiners, there's no question that they are taking aggressive steps to bump up their profit margins by either closing some refineries in the East Coast or by exporting fuel from the Gulf Coast. The real money is made in extracting crude oil, but we're seeing that the refiners are making money, and that has an impact on prices.
Great, thank you. All right, so many good questions. Let's see. We have about 8 minutes left, so let's see if we can get a couple more in. Okay.
Did you also want me to talk about, there are some efforts by Congress to address high prices by not only talking about drill baby drill, but also eviscerating environmental standards over the refining industry by not having refineries comply with stronger EPA air emission standards. And then we also have very clean fuel blends that federal laws require refiners to produce. And what we're seeing is the industry and some politicians pushing back and saying, well, these boutique fuels, these cleaner fuels, cost more. And they do cost a couple of cents a gallon more. But they save tens of thousands of lives in terms of vastly improving air quality, particularly for major metropolitan areas like Dallas, Houston, LA, New York, that aren't in compliance with federal air quality standards. So these cleaner blending fuels cost a couple of cents a gallon, but they're worth every penny. And so we have to understand that eviscerating environmental rules is not a path to lower prices. It's a path to disrupting the health, particularly of vulnerable populations like children and the elderly and people with asthma.
Great, thanks. I just wanted to make sure that we covered all of the different policies and ideas that are out there on both sides, both the Republicans and the Democrats, just to give people a sense of the different proposals and from our perspective whether or not they're actually going to bring down gas prices, and even if they were, what are the other costs or benefits that would take place. So thank you for explaining that. So the next question is specifically about the Dodd-Frank Act, and what our attendee wants to know is, what have senators done, and specifically Republican senators done, to prevent the enforcement of Dodd-Frank, and also has the House of Representatives funded any enforcement of Dodd-Frank? And then I would add there's probably a third element to this. What have the financial speculators done to prevent Dodd-Frank too?
Oh, absolutely. Great questions. Well, first, we have to understand that Wall Street has a hugely powerful lobby institution. We at Public Citizen, we don't accept corporate money. We don't accept government money because we want to be fiercely independent, and we think that accepting money from those types of sources would compromise our independence. And what we're seeing these Wall Street lobbyists do is work mainly with Republicans, but with a few Democrats, to do several things. One, continually sponsor appropriations bills that would gut the enforcement agencies like the CFTC by robbing them of the necessary funding they need to do their work. Two, the House of Representatives has put together numerous pieces of legislation that would almost completely eviscerate the energy trading regulation aspects of Dodd-Frank. And all of this has been promoted by Wall Street lobby trade associations that talk about how expensive it will be for them to comply with these new regulations. And my answer to that is how expensive it is to the American economy to let a small handful of speculators unilaterally dictate the prices that we all pay. And it would be one thing if they were turning around with those record windfall profits and investing in sustainable transportation. They're not. They're, offshoring that money in the Cayman Islands and doing all sorts of other unproductive things while American consumers suffer the consequences. So yes, there are aggressive efforts by this Congress, both in the House and the Senate, to defund the traffic cops on the beat and to do away with the underlying statutes that would hold Wall Street speculators accountable.
Thank you. I might also suggest that some of those huge profits are going into campaign ads this year.
Oh, absolutely. Citizens United has transformed the electoral landscape, and the more money that the oil companies and the financial speculators have, the more money they're going to spend pushing their radical agenda on the American people in the form of very expensive advertising campaigns.
Great, thanks. So we're almost at time, but I do want to take one last question. It's something that we touched, I think Tyson has touched on in the presentation a little bit, but it's certainly an issue that we talked to you all about a lot over the last year. And it seems like people are looking to have a follow-up, what's happening, what's being done. So the question is coming from Linda West, and she wants to know a little bit more about the Keystone Pipeline. Specifically, what are we doing in regards to the pipeline at this time?
Great question. We're actively engaged in a coalition effort to oppose the Keystone Pipeline. And what Public Citizen is doing, Public Citizen is in this unique space. We're an environmental advocacy group, but at our core, we're a consumer advocacy organization that is all about protecting the interests of working Americans. And our analysis of the Keystone Pipeline is that it would actually raise gasoline prices. That's because we're already getting 1 million barrels of tar sands crude into the United States every day. That crude is going from Alberta, Canada, into the American Midwest, to Ohio, Illinois, Indiana, where it's being processed and turned into gasoline there. Gasoline that is processed in the Midwest is for the United States market. What the Keystone Pipeline is designed to do is to move that oil instead down to the Gulf Coast, down to Texas and Louisiana, where it can be turned into gasoline for export. And that's the issue. This is about importing Canadian crude oil to export the gasoline. Never mind the catastrophic climate change and environmental impacts from tar sands oil. I've been up to the tar sands. I went up there in 2007 and saw it with my own eyes up at Fort McMurray, Alberta. And it's devastation on a grand scale. And more Americans need to understand that the tar sands oil is a moral issue. This is about the future of our planet. It's about the sustainability of the Alberta ecosystem, and it's about moving to cleaner sources of energy that aren't killing this planet and destroying communities and making us go financially bankrupt in the process.
Great, thank you. So we are at time, unfortunately, and still have a lot of questions, great questions that have come in. So I want to let people know one of the things that we'd like to do by way of follow-up is to try to couple some of these questions together that are related to each other, and maybe put together a blog post that will answer some of the top 3 to 5 questions that we've received and weren't able to get to today. So we'll promise to get that out to you guys as well. I also see I'm also seeing a question regarding can we get some talking points, just some basic talking points that we can use to write to our legislators and local newspapers. Absolutely. We'll make sure that we get all of these tools and resources for you up on our website right now to learn more about our gas prices and the work that we're doing. You can go to www.citizen.org/gas prices beyond supply and demand. So that's our current page where our work is going to be featured, and hopefully by next week this webinar will be featured there as well. So again, thank you so much everyone for joining us today. I think we had a great conversation, and thank you. Tyson, did you want to have a last word?
Just thanks again to all of our supporters out there, our activists. We can't do the work we do without your support and without your activism. So thank you very much.